Stocks keep hitting records. However, put-call ratio is favoring market correction currently. Interest rates could drop further as the bond rally continues. Dollar keeps rallying higher while gold still looks vulnerable as a result. And we will see if shorting oil is making sense again. All this and more in today's edition of MasterChartsTrading.com market recap for already Sunday, June 23rd, 2024. Usually I release the videos on Fridays, but I was traveling all weekend. My plane was late due to weather conditions, so unfortunately you can see the video is being released on Sunday, the 23rd of June in 2024. Don't forget to hit the like button, share this video, as always make a comment. If you're a subscriber, stay tuned. There's going to be a separate video covering various securities. If you're not yet a subscriber, click the sign up button in the video description and follow the link. Looking at S&P 500, you can see on this chart, as always, I'm using my MasterChartsTrading.com price action indicators, this green, blue, red, and yellow lines. On this chart, you can see that what we do normally is when the security kind of comes down towards the blue line and then closes yet again above it, this is our buy signal. It's pretty straightforward. I have a separate video on how to do trading, but if we just look at this video, or rather at this chart, this is S&P 500. I personally bought S&P 500 SPY right there back in October of last year, 2023. I'm still holding about half of my position because I sold half of my position back in January of this year, 2024. Notice that we just hit another all-time high. So for now, this is a high, all-time high from 20th of June, from Thursday of last week. For now, nothing out of the ordinary. We're so far following our regularly scheduled record highs. I'll get to market breadth in a second, and I'll show you that there is a chance that we might be pulling back because literally everybody is thinking that the stocks will continue higher, and this is usually a recipe for at least a pullback. But for now, let's enjoy it. We're keeping the positions open. Let's just keep going. We'll see where this takes us. So here is that what I wanted to share about the market breadth. So what we're looking at here is this is on StockCharts.com, ticker symbol $CPC. This is a CBOE put to call ratio. And this is a 10-day exponential moving average of the put to call ratio. So I'm referring to this dark blue line. The parallel lines, this red, green, and dotted line, these are just sort of boundaries of where we can expect the action to occur. Occasionally, you can see that it comes out of those boundaries. And usually, this overextended readings mean that we're going to have the opposite. So when the put to call ratio becomes too much in favor of calls, in other words, everybody's thinking that the stock market will continue higher, exactly at that point, we will normally, sometimes, or quite often rather, see a corrective action. So you can see this occurred back in February of 2023 when we had a lot of calls. We had a smallish correction. Again, around June, July, August of 2023, we had quite a bit of calls, and eventually we finally had a corrective action. The opposite is also true. So when we have too many puts, in other words, people are thinking that the stock market will collapse. The opposite usually or quite often happens. And for example, here's several such examples. For example, one in August of last year, 2023, when we had way too many puts. And then we had a small rally. Same thing again in October of last year. And finally, in November of last year, we had kind of too many puts. Too many people think that's bearish indications. And the opposite happens. We had a rally. It doesn't work all the time. And also, it doesn't work in the sense of how far out of the bounds the price or rather the put call ratio will be. So for example, here in 2023 March, we had a put to call ratio of not that much, not that huge, yet we got a tremendous rally between March and July of 2023. And sometimes completely opposite things happen. So for example, here we had on April of this year, 2024, we had a significant amount of puts. In other words, people thought that the market will collapse. Or rather, indeed, people were thinking that, market might continue lower from here, and indeed we did that. So it doesn't always work that way. It doesn't always work in the sense of if we have too many calls, expect a pullback, and if we have too many puts, expect a rally. Sometimes just something else happens. So not a terribly useful indicator, but sometimes it is useful. And currently, I think it's that time. You can see that we have a lot of calls right this instant. So many calls. We have a 0.86%. So in other words, the ratio of put to calls is 0.86. So there's a lot of calls right now. Will we get a pullback is $1 million question. I think we are sort of getting there. And if we look at the weekly chart of S&P 500, the weekly candlestick already sort of feels a bit toppy. I'm gonna just zoom in on it a little bit. Could this be a shooting star candlestick? Sure, it's possible. But it's also possible that it's not going to be a shooting star candlestick, and we're just gonna keep going stronger and higher. I mean, we had a tremendous rally, really, depending on where you can start counting this rally, but even the last alert that occurred in October of last year just was a blockbuster hit. Huge move out of the spark, basically. I mean, you can see that we bought S&P at around 4,200. It's currently at 5,400. So it's a very nice, I think it's a 20-some% gain. It's a 28% gain, so almost 30% gain. So for now, I would just keep in mind that there is always a possibility of a correction, and I wouldn't get too complacent. So put to call ratio is telling us exactly that. Can it become even more in favor of calls? Yes, and it indeed occurred. This indeed occurred back in June and August of 2023. It got really far out into too many calls category. Too many people think that's bullish. But for now, we don't know. It could just keep going. Stocks could just keep going. We don't know when it's gonna end. So that's the key part about trading, I think, is there's a lot of uncertainty, and many people cannot deal with uncertainty. So for those who cannot deal with uncertainty, I would, recommend not trading, basically, just doing long-term investments. So let's keep an open mind. Let's see where this takes us. For now, stocks are in an uptrend, and we will continue treating them as such. We're looking currently at 10-year Treasury note yield. So 10-year Treasury note yield is the sort of a marker for which many of the banks and various mortgage companies offer various loans. So for example, mortgage companies obviously offer mortgages, and mortgages have been coming down. I think we topped out, the markets, rather the yields have topped out. Let me show it to you on the weekly chart. So the weekly chart shows that yields on the 10-year Treasury note topped out in October of last year, 2023. And so far, we have not been able to recapture that level. In fact, if you kind of zoom in on the action, you can see that on the week of Monday, the 22nd of April, the price or the yield came up to 4.7 or so, touched this green support resistance line, and then bounced off of it. So right now we're threatening to break below the red line, and that would imply a bear market for the yields. So once again, a outright bull market for the bonds. Yields and bonds move in the opposite direction. So currently we're looking at the yield. I think the yield will continue to come down, and it could become actually quite precipitous. It could come down relatively precipitously if we have a convincing support break below the 4.17 level. I'm reading it right off the chart. It's this red line. So you can see it's right there, 4.17% for the 10-year yield. And if we breach that level, I think we could just quickly move towards like 3.6 area. And I think we will continue lower, as I said, and easily we could continue lower towards, end of this year, towards around 3.2% for the 10-year yield. This is obviously despite all of the various news, or perhaps because of the various news. The Federal Reserve is talking about lowering the interest rates. However, they're concerned about inflation, etc., etc. But the market is doing it for them already. So the free market that we have here in the Western world is already doing exactly that. The interest rates are already coming down, and most likely they will continue to come down further. And the reason for that is because of the Treasury bonds. So currently we're looking at IEF ETF. This is a 7 to 10 year Treasury bond ETF, and notice that we're gonna go at the daily chart again. So notice the daily chart, we are in an uptrend. We have broken above the blue line. I am personally long. I bought IEF back in February of this year, and I'm still long, and I'm holding a position in 7 to 10 year Treasury bonds. So bonds rallying, yields coming down. Normal relationship, nothing out of the ordinary. We will continue monitoring this, but again, I think lower interest rates are ahead, and this will help many people who are struggling with various bills, as well as potentially stimulate the real estate industry, and potentially stimulate the refinancing industry as well. So stay tuned for that. Let's switch gears. We're currently looking at DXY, dollar currency index. So notice this upward facing arrows. These are all some signals to go long, to buy the dollar. We have a signal when the security closes above the blue support resistance line, and this has occurred on multiple occasions since February of this year. Additionally, I think a very important note here is this area where I just made a circle back in March of last year, namely March 8th of this year, 2023. The stock, in this case dollar currency index, came down towards the red support resistance line, bottomed out there, and rallied. So This is showing that we have good support at the red line, and additionally that the market for the dollar is bullish. Dollar and gold normally move in the opposite direction. So I'm just going to quickly show you the relationship between dollar and gold. And there it is. So normally, notice this correlation coefficient down below here. And this dotted line is the 50, or rather is the 0 line. So anything below 0, it means it's correlated negatively. So it means that if the dollar goes up, gold will go down, and if the dollar goes down, gold will go up, normally speaking. Occasionally we have these weird situations where when, for example, dollar goes up, gold also goes up, or if dollar goes down, gold also goes down. We are currently in the middle of such a episode. We are about 66% positively correlated, meaning that when the dollar is moving up, gold will also be moving up. So at this point of the game, dollar is definitely moving up and in an uptrend. But so is gold. Gold, this is XAU divided by USD. Notice all of this opportunities to trade gold, to buy gold at the blue line, pretty much non-stop since 2023, January 2023. So once, right this instant, gold is having a bit of a rough time getting above this green support resistance line. I thought that we finally have broken out on Thursday, this last Thursday, the 20th of June. However, it seems like we have not yet done that, and we actually on 21st of June turned around and we have closed below this green support resistance line. Now, again, notice that gold, these are actually all-time highs. So we're pretty close to all-time highs, and trading next to highs, especially record ones, usually implies a bullish security. So gold is currently in an uptrend. However, dollar is also currently in an uptrend. And as I just showed you, if dollar decides to no longer be in correlation with gold, but rather be negatively correlated, as is normally the case, we could see dollar continue higher, and gold, by extension, will pull back. So we're watching this as well very closely, and to see if gold will win this tug of war or the dollar will win it. And let's wrap up with oil. So light crude oil, ticker symbol CL1 exclamation point. And for now, you can kind of see that oil broke below this red support resistance line, and by extension, this means that oil is now in a downtrend. However, after a relatively sharp move, oil bottomed out here on the 4th of June and now rallied strongly higher. So we're back above the red line. We're not yet back above the blue line. If we were back above the blue line, then we are definitely in an uptrend. But right now, we're not yet in an uptrend. So I wonder now if it's a good idea to sell gold short, wait for a signal to sell it short again when we close below the red line. I think this would be the most prudent action, because this way we'll actually at least have a signal. But up here right now, there is really no signal. I mean, we can look at 4-hour charts, and on 4-hour charts we also have a breakout into an uptrend. So we'll see where this takes us, but I wanted to show it on the weekly chart as well. And it's a relatively interesting situation, so to speak. So we're looking right now at crude oil on the daily time frame. Notice that the prices kind of tried to break below this levels of around $63 to $71, and I highlighted it with this rectangle here. And so far for the past, let me see, this started to happen December 2022, so about a year and a half now, they were not able to break below that $63 to $71 area. In fact, another time that this just occurred, it just occurred again right there on the 3rd of June, and oil rallied afterwards. So this is an interesting situation. Clearly there is support in this area for whatever reason, and whoever is buying this, because there's no way to know exactly who is trading what and with whom, there is basically good support in this area, $63 to $71 area. And as a result, I am somewhat reluctant to sell it short. However, we could start buying it, and it's approaching that level where we want to be starting to think about buying it at the blue line. So oil currently is in this weird state of, obviously, a lower prices cannot be realized, but the higher prices, we will see if they're going to be realized. Let me know what you guys think about any of the securities we traded that was mentioned in this video. So S&P 500, Treasury bonds, dollar currency index, gold, and oil. And other than that, head over to MasterChartsTrading.com, click on sign up for one of the products, and I have a trading indicators. So this line on the chart, you can have them on your chart, this green, blue, red, and yellow line. This will help you trade much easier, and it will help you trade with just much easier to visualize price action. So these are trading indicators available for tradingview.com, $24.95 per month if you buy the yearly subscription. Newsletters are available also. So for example, this past week we covered all of these various securities. We have coverage for ETFs, foreign ETFs, large cap stocks, as well as speculative stocks, and gold as well. And of course, the best deal is to get both trading indicators and newsletters. And again, at $49.95 per month if you buy the yearly subscription, it's a steal. So head over to MasterChartsTrading.com, sign up, and I'll open the door for you for the trading indicators, and you will receive immediate access for the various newsletters that I offer. That's it for this week's recap. I thank you very much for listening all the way to the end. And once again, I apologize for the very late video. However, hopefully next week it will be on time. Thank you for watching. Have another great trading week. Bye-bye.